Hi, everybody. Thanks so much for joining me. Before we get started, please take a minute to click subscribe to my channel to keep up with all of my latest stock market and personal finance content. And please check out the link you see on your screen right now for a special message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So, if you're like me, you've probably had a few losers over the past year or two, especially if you invested in any of the X SPACs in the market or recent IPOs, or just had a lot of high flying tech stocks in your portfolio. You probably have some losers. So I spend a lot of time on my channel talking about stocks that I think are going to do really well over the next few years and stocks that have been big winners. So I figured I'd take a minute to talk about some of my biggest losers from my portfolio and what I think about them now. It's a really important lesson for investors to learn that just because a stock is down doesn't necessarily mean it's bad. It's really important to take a look at the reasons for the poor stock performance. Did it just get caught up in a market frenzy and it's an otherwise good business? Or is there something fundamentally wrong with the company? I have quite a few losers in my portfolio over the past year, quite a few winners too, but a few losers that I want to talk about, some of which I'm planning on keeping and some I'm planning on getting rid of. So here's a shot of my four worst performing stocks. You can see them in order right there. Number one is Latch, which is down about 90% from where I bought it. Number two is 23andMe, which is down about 76% from where I bought it. Number three is Fastly, which is down about 75% from my cost basis. These are all from my cost basis, by the way, not the actual decline in the stock over any period of time, just from where I bought it. And last but not least, Lemonade is down 70% from where I bought it. These are my four biggest losers in my portfolio. And fortunately, all four were relatively small positions for me. So they weren't big dollar amount losses relative to some of my larger investments. Most of my larger investments are real estate investment trusts and relatively safe stocks. So, do I like these anymore? So let's start with Latch, my biggest loser since I bought it. Latch, I don't know if the business is doing well. The biggest problem with Latch is it's behind in its regulatory filings, which is a big red flag. There are few red flags that are worse than that. Latch hasn't filed earnings since the first quarter of 2022. It's missed quite a few numbers. So at the time, Latch had a lot of cash on its balance sheet. Does it now? Your guess is as good as mine. It's done a bunch of layoffs and things like that to try to get costs under control. Have they been effective? I have no idea. Is the business continue to grow the way they said it would? No idea. So the business might be doing well, but I don't think I'm going to wait around and find out. This is one that I plan on getting rid of at some point in the near future. Moving on to 23andMe, this is the other X SPAC on the list. This was brought public by Richard Branson's SPAC from Virgin Group. So, unlike Latch, this is actually a business that's making good progress, is doing everything right for the most part. It just really went public at too high a valuation, if we're being totally honest. So, 23andMe, they're expanding their core business. We all know the home DNA testing. This has given them by far the biggest library of genetic material from the general population of any company in the world. It's a tremendously valuable asset, especially when it comes to developing pharmaceuticals. But it continues to grow that retail part of its business. It has a premium business where it gives people premium reports like how vulnerable they are to certain types of disease and things like that based on their genetics. The drug development pipeline remains very high potential. There's only over 50 therapeutics in development using 23andMe's genetics, many of which are wholly owned by the company. As any pharmaceutical investor can tell you, even one successful drug could be worth billions. But this is all very early stage. It's going to be years till this pays off. The retail side is not making enough money to offset the losses from the other side of the business. It is expecting about $200 million in adjusted losses for the year. Now, that's not necessarily a terrible thing if the business keeps growing and making progress, but it has about $440 million in cash, so it has some runway to absorb those losses for the time being. I still like this one, but I consider it a very highly speculative investment. A lot of things need to go right for it to work. But at the current valuation, like I said, it lost about three-quarters of its value since I bought it. I think I am going to hang on to it. I'm not going to put any more money into it, but I'm going to keep this one. Now, Fastly, I'm admittedly on the fence about. There's a lot to like and a lot to not like. The growth has not been impressive compared to companies that do similar things. To put it in very simple terms, revenue was up 25% year over year. A lot more, cloud platforms and edge computing things are doing a lot better. They've had a few stumbles in the business. Gross margin isn't nearly as good as some of the other major players in the space. It's still losing money. It's expecting an $80 million loss for the full year. Um, but there is some things to like. Customers seem to be very happy with the platform for the most part. Net revenue retention is up to 118% over the past 12 months, meaning that customers are spending more with the platform as time goes on. It has over $500 million in cash and securities on its balance sheet that so it can absorb those losses for the time being. And it has just over $1 billion market cap. Trades for about 2.5 times sales, which kind of feels about right now. This is one that just kind of went meme stockish in the whole frenzy a couple years ago. So it's one that I'm going to hang on to for the moment, but they really need to show me something in 2023, or I'm probably going to get rid of this one too. Last but certainly not least is Lemonade. Lemonade's been doing a pretty good job of executing on its vision of disrupting the insurance space. Insurance is a clunky industry for the most part. If you ever gone to buy life insurance, it's kind of a difficult process. So in Q3, Lemonade sales were above estimates, but the company's just losing money too fast. It posted a $91 million loss versus just $74 million in revenue. So its profit margin is actually over negative 100%. So it expects its losses to have peaked, is the good news. It expects to start narrowing its losses. It's intentionally pumping the brakes on growth in order to, slow losses. And there's still a lot of potential here. The auto insurance business is still in the early stages of its rollout. It just launched in Texas. It's only in a few states so far. So Lemonade is one that I like long term, especially at the current valuation. It's trading for not much more than the cash it has on its balance sheet, and it thinks it can get to profitability without having to raise any more capital, which is a big question mark, but it would be a very good thing if it happens. So of these four, I would say that Lemonade is the one that I'm most confident about getting back to what I paid for it. It's still a big if. Number two, I would have to rank 23andMe as the stock that I still like out of these. Then number three is Fastly, and a distant fourth would have to be Latch at this point. So those are my losers. And it's important for long-term investors to understand if you have a diversified portfolio without too much of your money in any given speculative asset, like some of these, then losers are okay because your winners can dramatically offset them over time. I have a 550% gain in shares of Block or Square, for example, even after the recent decline. I have a 380% gain in a company called Ryman Hospitality Properties, a hotel operator. So gains like that can more than offset losses. So a lot of investors have losses of 70% or more in their portfolio right now. And if some of the stocks you've bought over the past few years are still great businesses, you might want to hang on to them because you never know which ones are going to be your long-term winners if the business is doing well. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.